This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. So today on the show, I have Brad Rathe, and Brad is a fund of funds manager, meaning he has a fund where he allocates to other traders, many of them in the systematic trend following space, and also runs his own global macro fund. Brad, thank you for joining me today.
It's great to be here.
So you have got an interesting connection here. It's Jonathan that connected us, right?
Yes. He actually was an intern for me maybe 5 years ago when he was still in college.
And Jonathan is a Facebook friend. I've not met Jonathan in person, but he was like, "Hey, you got to talk to my buddy Brad." And I was unfamiliar with your career, and I looked at some of the bullets. And I was like, "Well, that's interesting. There's some people, some experiences in your world that I think will make for interesting fodder." And I'm sure you can enlighten us on some things. But why don't you go ahead and lay this out? Did you grow up in Chicago?
I did not. I actually grew up on a farm in Iowa and then moved to Minneapolis when I was like 13, and then went back to Iowa and went to Iowa State University. And then the day I graduated college, I moved to Chicago to try to work on the floors.
Oh, that's what you did. That was one of your first steps, right?
Yep.
You were down in the pits. Tell me the path of you right out of college. Date the year. What year are we talking? Right out of college, what year?
89.
So 89, and you show up in Chicago, and you want to work in the pits. What's your first step? What'd you do?
I actually phoned a bunch of people I kind of knew from college, and I had some friends at Iowa State. Had, I think, about half the people there were from Chicago, and so I knew a lot of people in Chicago, and so I just started networking. I was a waiter. I started as a waiter, and I worked in the meats. And the nice thing is, the meats guys only worked from 9 to 1. So they had the phenomenal career of, obviously now it's different with everything being 24 hours a day.
We'll clarify that though for some people out there that are you might have just jumped ahead with jargon. You're working in the meats. Why don't you clarify exactly what you mean by
meats? That? Was they don't even have it anymore. They don't have the pork bellies, which is bacon for the most part. That was a big pit back then. Live cattle, still a big pit today. Live hogs, still relatively a big pit. And feeder cattle. Those are the four main. And I bet we had maybe 500 people in those pits at the time.
Were you a big guy?
No, actually, I wasn't. And that was to a certain extent why I kind of got out of the business. I was down there for about maybe 2 years. It was always kind of, it got populated mainly by ex-Bulls, ex-Bears players. And a lot of people wore flak jackets, and I saw broken ribs. I saw, it was a very, very physical game back then.
Let's clarify this for a second. So just so people can see this picture, we're talking the pits. We're talking late 80s, early 90s. All the hand signals, all the screaming and yelling that people generally don't know what is even taking place down there. And so you're in the middle of that war zone of trading. And were you trading your own account?
No, actually, I was a broker. I worked for another guy. He was a Canadian dollar trader, and so he's the guy that kind of got me started.
Gotcha. So what you're saying, the size of the guys, it became an element of how prices were transacted in the pit was how big you were.
No question about it. And I guess a famous story, and you probably know this story in the Eurodollar pit, which became huge, in the early 90s when I was first getting down there. A guy sold his spot in the pit for $1 million. He could stand in that one spot. He was a big dude. He had direct line of sight to as many people as possible. And it was a famous story in like the early 90s, but the guy sold his spot, even though in reality, anybody could stand anywhere. But you would get down there every day and you just had your spot where you would stand every day. And so that was pretty interesting back then.
Well, paint me a picture of how big was this guy?
It was probably 6'4", probably 270, 280. And that was kind of the classic type of trader, especially in the futures. When you went into the option pit, and then I started to look more that direction. That was a bit more cerebral, but in the futures pit, it was much more physical. You had even the guys in the off season. I have some good friends now that are still, ex Blackhawk players. That's where they started. There was a lot of ex Bulls, Blackhawks, Bears that were in the pits, and in the off season, they bought their seats, and what they would do during the season, they'd rent it out, but during in the off season, they would actually work in the pits.
Yeah, there's a book that I read that I recommend to everybody. It's called American Pharaoh, about Daly, old man Daly, and him basically launching current day Chicago as it is. And I'm already starting to see the parallels as you described the pit. But I want to this might sound silly to you, but as somebody who, I've been down on the floor before, but I've never, I never worked in the pit or anything. So the guy that's 6'4", he's 270, 280, he sells his spot. Now his spot that he was standing in, it wasn't like he owned that spot. It was simply he
just respect for the most part.
Okay. Now, were there points in time where people would say the respect didn't exist, and literally it would be a little bit of brawn would push someone out of a spot? Would that, and is it that?
Well, no question. And also when they changed the floors, probably the probably late '90s, they changed some of the floors and they moved, and I tell you, that was crazy, because you had these guys that were standing in the same spot for 10 years, all of a sudden now they build a new floor and everybody has to go over there. There was a famous picture, probably in the late 90s, of how big the Eurodollar pit was. They put a 747, they kind of obviously transposed it in there, but it was in like a magazine cover of putting a 747 in the middle of the Eurodollar pit. So it just kind of shows you how big, that pit was.
Yeah, it was amazing too. I can't remember. I guess we were talking mid to late '90s when they both redid their floors, the two biggest exchanges, and then within a couple of years, they're pretty much ghost towns, aren't they?
They are ghost towns. There's some going back. I have a friend that actually just went back onto the floor, but a lot of it's options. Yeah. Guys that do big option books, they'll go back to the floor because one reason it's a lot cheaper for them to go down there. But yeah, the futures pits, there's really nothing. And even just recently, you had the grains go 23 and a half hours. I think that's going to probably go all screen based too.
I'm going to try and pull it out of you a little bit here in this conversation today, and not to get you to drop names, but I just think you've had some interesting experiences in your career. And some of the other traders, obviously you've had some nice success on your own, but you've worked with some really successful folks too. So there's a lot of cross-pollination there. But while you were on the floor, were there any, whether named or unnamed, individuals that had a dramatic effect on how you viewed the world of trading?
Well, I think to a certain extent, watching the physical nature and it was such a different game on the floor, especially now in retrospect as me leaving the floor and being 20 plus years, on the hedge fund side and the systematic side and that side. It's just a completely different game. And even for when I was running research shops, I used to have a lot of the floor guys, especially in the early 2000s, when the floors are starting to die, they would come to me and say, hey, can I work with you? Because I just can't make a living on the floor anymore. It's just a completely different game. It's all about, flow of information, and you can't get that from a screen. You can't get an edge. You always say, all right, when you sit down with a manager or a trader, you say, okay, what's your edge? And the edge for those guys was they saw the flow coming. They saw Goldman had a huge, order coming in. They could use that information, to trade. Once you get off the floor, it becomes more and more important to have a systematic, unemotional type of trading approach. And that's obviously what I've worked on for the last, 20 plus years.
Well, let me move you out of those early experiences. I just think it's some great color, and I think it really establishes an interesting foundation for your career. But and the transition, your transition from the floor, was it directly from there to EMC?
No, what I went off the floor, and it was right when Globex was starting, and there was a broker that was on the floor, and they said, "Hey, we need somebody with good computer knowledge. Can you come up and help us kind of start Globex?" So it was like the first 6 months of Globex. I worked off the floor. It was a small. Actually, I had one company is called Stotler. They actually went bankrupt I was there for like 2 days, and then eventually I moved to Index Futures, and I'm not even sure if they're in existence anymore or not. But that was kind of the beginning of electronic trading. Globex was just starting, and so that's how I started. And then a friend of mine introduced me to EMC. I was off the floor for maybe 6 months, and then I went to EMC, and that was probably in 90, maybe 91, 92.
Well, I know there's some people that follow my writings and whatnot, but why don't you explain EMC and the main principle of EMC?
EMC, Liz Cheval was the main principal, and when I first started there, she was married to Dave Cheval, and the two of them met on the floor. Dave was a trader in the bond pit for a long, long time. Liz actually started in the bond pit as well, and that's kind of how they met. And she answered the ad, that has become famous of, they're looking for people that could, see if they could train traders. I'll go back even a step further. You've probably, talked about the story of Bill Eckhart and Richard Dennis, the famous bet. Can you train traders? Or are they made? That was the whole turtle thing in Singapore. Where they would grow these turtles. And that's kind of where the whole turtle concept came from.
I'll have to send you my second book.
Yeah,
it's the whole turtle story.
Is it?
Yeah.
It's a great story. It's a great people. And I'll kind of get into how I met all those people, and but that was kind of So Liz, was involved in these first original 12 turtles. They worked there for maybe was it 2 years, I think, and then eventually. They all broke off into their own. You have Chesapeake, you have EMC, you have Jim DeMaria,
Hawksbill, Raybar.
Hawksbill, Raybar. And some of those guys are definitely still trading, to this day. But I guess the key thing about that whole story was there was a CTA business. I mean, you had John Henry, you had Dunn, you had a couple other people that were involved in the CTA business at this point, but it was extremely small. I would think the whole number was probably less than $1 billion. Probably in the early 90s. By the end of the 90s, you had this turtle group managing, I forget what the number was, but it was probably closer to $8 to $9 billion, and they were probably 75 to 80% of the whole CTA business, at that point. Yeah. And so, in my opinion, obviously
the London CTAs have changed that now, but at one point in time, you're right.
No, and I think in my opinion, obviously, I think other people would probably disagree, but I would say that group somewhat started the whole CTA business. There was small amounts of it before, but there wasn't that big.
I think if you look back and you say, okay, in the late 70s, you had Campbell and Dunn and Milburn, and then the early 80s, John Henry joined. Larry Height got meant to be up pretty big in the early 90s.
Yep.
And that's kind of the path. I mean, obviously, can get more detailed than that. Why don't I let you explain though? Also, so. Getting back to you starting at EMC and how that happened and what you did there initially.
How it happened was I got introduced and I had an interview with them. They were actually out in Hinsdale at the time. I think there was 3, maybe 4 people there. A guy named Abby was his last name. He was the director of research. Jennifer, I don't remember her last name right now, was the head of trading. You had Liz, obviously, she was the CEO, and you had Dave Cheval. He was the he did all the marketing, for them. And that was all the people that were involved at EMC when I got there. And so when I got there, I started as a trader. For the most part, there was no European or Asian futures contracts at that point, or at least nothing that was liquid. When they first started, with the turtles, everything was just U.S. based instruments. And so what they kind of brought me in to do was I started trading all their offshore futures, systems. And so I started Australia. This is probably 93, 94. I started with, and then I moved to, we added life. Eurex really wasn't in existence. That became a little bit later, probably in the later 90s. So my job was to trade the systems and help them develop, I guess, changes to the systems. And I had a kind of a computer background, so I started helping them develop, I guess, platforms on how to test, for new systems. And so that was kind of my role at EMC for the first maybe 4 or 5 years. And I worked in the middle of the night for, I think, four or five of those years. So that was my role.
I've had a few interchanges here and there with Liz over the years, but obviously with someone who's had that long of a career in the hedge fund space and with a good amount of success, she obviously has taken all those early principles that she learned as a turtle and obviously has become a quite successful businesswoman. What would be some of if you were sitting down with a young high school student and you were I know obviously you're going to have some other things that we could talk about going forward here, but I'm just, at this chapter of your life, what would have been some of those lessons you would have learned from either listening to her or watching her early on? What would you'd pass along to some young person today that's kind of stuck with you or perhaps even changed you a little bit early on?
Well, I think the key thing with all those turtles, I think they all had an amazing amount of humility. She certainly never, I haven't seen her in a couple of years. We had dinner a couple of years ago, but unbelievable humility. Just one of the nicest ladies that you could ever come across. And I guess how unemotional, she was to everything. I mean, we used to carry, huge positions compared to how they trade now with, 12 to 15 ME, type of, trading. We were 40 to 55%, margined equity, back then. I mean, we were up, we had years that we were up 70, 80% in June. And so you would, like a grain move of like today, you would see the turtles up 140%. So it's a bit different business today than it was back then. But I guess the thing I learned from her most is that just how unemotional you need to be and how you just have to do what you're supposed to do every day, and eventually things will work out. Probability's in your favor, and you have to just be unemotional in what you do. I guess that was the thing I learned from her the most. Especially back then with the size of positions that we had on, it was pretty amazing. I didn't realize it until probably, 7-8 years later, how unemotional she was under some pretty stressful situations. I mean, we had Barings go under. We used to talk to Nick Leeson, right before that whole thing. He was one of our brokers in Singapore. So, that was, I guess, one of the first real big blow-ups, in the world economy. I actually been looking through some of those recently, and the Barings situation was a big one. Yeah. And how she handled that and how unemotional she was to it, and she just did, what she was supposed to do was pretty incredible. And that was always, I guess, what I learned, most from her.
It's interesting you talk about the higher margin to equity ratios back in the day, and maybe perhaps more of an attitude in the 80s and early 90s where it was still to try and shoot for the absolute return, to shoot for the home run money, where clearly by traders' actions, they were in the game to get rich. And I wonder, it's kind of a side note before I kind of continue where you went after EMC, but I wonder if the idea of somewhat leaving absolute returns to cater and this is where we're at today, and we'll talk about this more, but to cater to the family offices, the pensions, the institutional investors that all basically say, we just want low volatility, low standard deviation. We don't really need to make a lot of money. I sometimes think that the whole idea of trying to control risk to some degree and kind of dialing down your performance actually goes against the very nature of what trend following was delivering to begin with, which is this kind of unexpected massive return when the big dislocations happen. I don't know. It's kind of
I think no question about it. I mean, I think, I guess an interesting dichotomy in my career is you go from probably one of the best, we used to call it high vol traders in the world to when I went to Rotella, which I would consider, Rob probably one of the best low vol traders in the world. And it took me a while to get used to it. And I guess it's a completely different rationale and a different mindset of how you kind of have to approach trend following. I mean, both of them trend following, both of them systematic. But Liz, no question, and I think that's to a certain extent why she's probably struggled, probably for the last 10 years, raising additional capital. Because when I left in, I don't remember, it was maybe 97, 98, she was I think we topped out at 330 million, in the early to mid 90s. She's under that now, and what is that? Whatever, 10 to 15 years later.
Yeah, I think that I think it's the loyal people that kind of understand perhaps what she really does, but the new world of investors are they like the premise of what Harding delivers. And then I think what happens also, it feeds on itself. And I've talked to funds that are maybe slightly under $1 billion, and they actually, they'll deal with investors that are like, well, why should we invest with you? You're not even over $1 billion. But look at this other fund, it's 20 billion. It's kind of an odd world. I don't know where this all ends up going, but we can theorize.
Well, it's interesting because if you actually do the research, those guys that are at $1 billion and really just trying to, I don't know if the hold the ass is the right word, but they're certainly not getting any alpha on their money. There's definitely the smaller manager, the manager that is trying to maximize his return. He can still trade the breadth of markets. That the billion plus or the $5 billion manager, he can't trade the grains very much. That's when you're going to see this month the smaller managers are going to outperform considerably. Because you have these smaller markets, and that was what the turtle system was originally, built to do. You take 50 markets, you trade them relatively equal, and you're looking for a corn market that has a 30-yen move. And that's what the turtle system was kind of built on. That one contract that really explodes, and you make all your money. I mean, like, you go through the years, like a 1994 coffee, even corn this year, you make your moves on that 20-yen move. That's where you make your money. And without those, it's a bit harder to, make your money in it on a year in, year out basis.
Yeah, and the decipher code there when he's saying N, just another term for average true range, ATR, same thing.
Right.
Let me let you jump into, because at some point in time you were at MCM for like what, 5-6 years?
I have, I think 6.5, something like that.
And you move on to work with Robert Rotella, and you end up a director of research there. I have not seen Robert's name for a long time. I'm not sure about his what he does today, but I know he is definitely someone who's had a tremendous amount of success in the CTA space and the trend following space. Why don't you go ahead and paint that picture a little bit for us?
So I met Robert through another friend of mine, John Stein, and John was the director of business development, and he was our legal counsel at the time. I think there was maybe 7 people at Rotella. He just moved back from Singapore and was on the 93rd floor of the Sears Tower. And I went and met him, and and he was looking for a director of research. And he said, all right, Brad, he goes, to prove that you can, do this, what I want you to do is go home over the next week, and I want you to write me a testing platform for trading futures. I said, okay, this should be interesting. So I went home and pretty much spent the next week, wrote my own testing platform for trading futures, brought it back to him the next week, and he said, all right. He goes, you're hired. And I said, don't you want to look at it? He goes, no, I trust that you did it. And so that was kind of how I met Robert, and we became actually extremely good friends. Again, another person, unbelievable humility. When I first got there, I think he was maybe 150 million, and by the time 6 or 7 years later, we were at about $1.7 billion, $1.8 billion. And again, what you talked about before, the marketplace somewhat came to him. It moved away from the Chesapeakes, the EMCs, the Hawksbills of the world that were shooting for, 50, 60, 70% returns if you had a really good year, to the guy that could consistently, try to get sharps of 2 and be able to have 12 to 15% return, but not have the down 10. If I think first 10 years, you never had more than a 10. I think his max drawdown for the first 10 years of his trading was 9.6%. Which was pretty amazing. We used to tell people you would have a 25% drawdown at some point in the year with EMC every year. And if you couldn't handle that, that was the other thing about the early days of the CTA business. We were very forthright. That was the other thing that was pretty interesting. Very forthright to say that you will have a drawdown at some point at 25%. And if you can't handle that as an investor, you shouldn't be investing in this space. Obviously, it's changed a lot. The odds of you having a 25% drawdown now have gone down dramatically just because people trade differently.
Well, there's still some CTAs out there though that will take those. I know. Dunn, for example, is still got that continuous track record back to 1974, and still manages a healthy amount of assets. And it's for the client that knows exactly what they do, and Dunn tells you, we will take a hit. This is what we do. Yeah.
No, and there's definitely a lot of people out there. If you go through the numbers every month, you'll see, especially a month like this month, you'll see a guy, or actually a month like 2 months ago, where you had Clark.
Yeah, Clark.
Clark, another guy that, real good guy. I've known him for years, and but he's a guy that's kind of still in that old vein of he'll have 20% months. Without a doubt.
Yeah, when I went and met with him for the first time, he was out in the burbs at his house. Yeah, I'd already had a decent feel for. At that stage in my existence, a decent feel for why the pump and pageantry really was not relevant to making money. But seeing Michael in his house where he worked was just one of those, it's one of those big light bulb moments where it's like, well, hold on. If this guy's in his house doing what he's doing, what's all this other overhead and nonsense that everybody else is doing? And it's just one of those great kind of light bulb moments.
It's just a lot of work. The key thing is you have to put in the work on the system side, because, I had the same. We used to allocate out, when I was at Rotella, we had a certain amount of funds that we'd allocate out to managers. I had a similar experience with Michael, and I sat at his kitchen table with him and his wife. And we just sat there for like an hour one morning. So I agree. It's pretty interesting when you meet, and he was extremely successful, doing very well. And we did allocate him some money, but imagine that due diligence process now.
Yeah.
If you're a big fund of fund and you walked in and you had coffee with the manager and his wife at his kitchen table, and I don't know if you would allocate him money.
It's funny. A couple. I guess I've had a chance to sit down with David Harding multiple times, and David's just, he's just like me and you, except he's running a $20 billion fund.
Sure.
But the first time I met him was like in 2005, and it was just me and him in his office in London, and he had this, I think, a Cocker Spaniel that just ran circles around in the office the entire time. And, to say that David had a salty tongue when it was just one-on-one would be an understatement.
Sure.
But it was nice because at that moment in time, I always said to myself, I don't know, because he wasn't of the size he was at that time, but it was one of those things where you could sit down with a person individually and get a feel for that person. And I made the judgment at that moment in time. I was like, I don't know how successful he'll be. Obviously, he was hugely successful already, but I was like, you just had a good feeling about the person. So I hear you when it's nice. Similar experiences with like Salem Abraham and those kinds of things where you sit down with someone. And it really is nice to be able to kind of get a feel for them as a person.
Well, I got to tell you, I mean, I have a certain access, and just like you have a certain access, but I've never not. If I've gone up and introduced myself to anybody in this business, I've never not had an extremely warm reception, very open, with you, and would say, hey, when you're next time and you're in California or wherever they're at, why don't you come in and we'll talk about systems, we'll talk about, the business. I love to do that. Next time you're in, let's do that. I've never not had that conversation with people that they weren't very open. Maybe the CTA business, we've always
little paranoia.
It's just I've never known any other business, so I'm a bit odd that way. But it's just some of the nicest people in the world.
Yeah, I have to second that. I mean, I've been very fortunate to, and I think it goes, if you are if you treat people well, they generally will treat you well too. But I have found, probably the secret to what I have done is to show all these very accomplished people that I get what you're doing on a subtle, nuanced level. So then there starts to be a little bit of trust built that you're not going to go out there and say something completely ridiculous. Sure. That's going to put them in a bad light. So I think that's part of the trick. What I want to ask you as we move on to, because I want to talk big picture trend following with you. Because I asked you about this with Liz Cheval too. What about with Robert? You mentioned humility also. Was there any big picture lessons that you walked away from being in this very successful firm that really stuck with you or perhaps changed you?
I think it kind of showed in the end with Robert moving to Seattle. I guess all the money and all those things weren't important to him. What was important to him was the truth and being involved with the markets, being involved in systems, and he really felt like he was doing something above than just making money. He felt he was doing providing a service to the markets because he was the liquidity provider. So I guess he never really, and almost everybody in the business isn't doing it for money. And obviously that's one of the benefits. But if you are there just doing it for the money, normally you're probably not going to have the success, that the people that are there just to trying to find the truth. Because it's a lot of work. I mean, it's a ton of work. And even now, I don't think you can just sit with the same systems. I mean, John Henry tried that. He had his same systems that he ran for 25 years. Not to say that they're deviating from trend following, but they're doing it in different ways, and they're having multiple systems. I mean, it's different than what it was, in the early 90s. I mean, if you do the testing and you look at how the business has changed and how the trend following has changed, it still works. But you may have to do some tweaking, some changes to it. And anybody that's still in it and doing well has, certainly made changes to, what the original idea was. Especially certainly the original system, maybe not the original idea. The original idea was obviously trend following, and a lot of it was psychological.
Yeah.
The original, book that those guys worked out of and all the notes that they took during the original sessions of the Turtles. So much of it was psychology.
Yep.
And if the market does this and a number comes out that should be bullish but isn't, it wasn't all systematic back then. Yeah. There were certainly a lot of things that built into the system and built into how they traded that was very much psychological, which I think timeless
psychology, I think you would argue a lot of it.
Without a doubt.
Yeah.
And so a lot of that's not built into the systems, and that's where some of those guys that trade the turtle type of system, but they add some of the psychology back into what they were trying to do. I think those guys are probably more successful than the pure systematic guys.
Yeah.
Because there was a lot in there. I mean, I would say half of it almost was psychological, and how the markets were telling you information, and you just had to listen to it.
It's interesting you bring up John Henry. I've used his success, his trend following success, is a kind of a one amongst many shining lights to learn from. I have a hard time though criticizing, and I'm not saying that's what you were doing, but clearly once he bought the Red Sox, and you mentioned passion, right? Once he bought the Red Sox, his passion and love, it's pretty tough to run two world-class, I'm just saying as a regular human being, pretty tough to be involved intimately with two world-class operations, Major League Baseball and trading. I don't know if he was on this conversation with us, what he would say if there was any kind of, if that was a tough thing to manage. But clearly he's taken a passion and put it to the baseball with pretty good results.
And he's a phenomenal guy. And the first time I ever met John Henry was we were just starting the Dean Witter Select Fund, and it was EMC, it was John Henry, and it was a couple other people, and he actually wore overalls to the first meeting that we had, and he was a very down-to-earth guy, extremely smart guy, but I think, like you said, I think he kind of veered off a little bit, and maybe that was the reason they've kind of struggled a little bit, and obviously he's gone in a new direction. Yeah. But unbelievably successful, and actually a world class, super nice guy. You meet him, the same as if everybody else that we've talked about. Just a really down to earth guy.
Yeah. I only spent a brief amount of time with him, and one of the things that I remember him saying to me is a real long time ago, and he just looked at me, and he's not a very big guy, and I was in a big room with him where a lot of people I don't think they knew who he was, and I approached him, and he just all he could really say was, it never gets easy losing money for people.
No.
So I thought that stuck with me all these years later, that that there is, it looks great on the outside, to somebody that says, wow, look at that hedge fund manager, he made all this money. But what they don't see are the clients that are calling, and the people that are worried about their money, and the people that perhaps made an investment and don't really understand the strategy. And then, there's a lot of hand holding and babysitting, and you could see how that could probably start to show in people's faces after a few years.
Well, also you got to realize with the trend following type of approach, usually you make money 2 to 3 months out of the year is where you make most of your money. So think of it, 9 months out of the year, you have everybody complaining.
Yeah.
So I mean, that's the part that makes it really tough.
Years ago, there was I was a Barron's reporter. She called me up. It was either October or November, and she called me up, and she's like, look at Bill Dunn, look at John Henry. They've lost all this money. It's going to hell in a handbasket. Their careers are over. And I was like, well, listen, why don't you give it a little time? You can't really make a judgment based on 1 month. And the very next month, they made all it back and then some. And she called me back. She's like, okay, now I kind of get what you were saying. And she kind of did a second article to kind of clarify that you can't just judge it on a 1 month performance. Unless you lose 100%, then you kind of know there's a problem.
Well, and they used to have 50% knockouts. I doubt they have those anymore, but that was always our starting point of any new client was, if you ever lost 50%, they would knock you out of the positions. Let
me ask you about your, because I want to, at the end of our conversation, I want to talk about some of what you're doing today. Two things, and I think I'm going to bring up the slightly negative part, because I think you probably have some strong views on this. Talk about MF Global and PFG. Why does it feel like, as an outsider, and I'm not a Chicago guy, I'm not a Midwest guy, I grew up in Washington, D.C., what in blazes is with this town, either politically in Chicago or the futures markets? Why can't this city seemingly get transparent and make it so the rest of the world can really believe in this stuff without things going kaboom? What is going on?
Well, First off, I would say that MF was a New York issue.
Okay. That's fair. I trace that back to Goldman Sachs. And look, I'm somebody that doesn't think the bank should have been bailed out. Okay, so I'm right there on, I don't, if they're going to make Lehman Brothers go home and they're going to make Bear Stearns go home, I'm not sure why Goldman Sachs didn't have to go home either. So that's a whole different conversation.
That is totally visible. But no, the man situation is still infuriating. I mean, obviously, I've been involved in it, and I had a lot of friends that were involved in it. I was personally involved in it. That one's still pretty amazing. The problem too is you can't guard against fraud, And I've been following the Peregrine, the PFG, Best or whatever story itself, and one problem that we're having is the FCM model is a bit broken right now, and so what you're having is these people take outsized risk. And I do believe that there's I don't know if you've seen the Attain article that's been put out, and they really want to have some things go on at the NFA just because of all the things that have been going on, but because there's no interest rate, and that was a good chunk of where the earnings came from in these FCMs, they've changed the business model, and it hasn't quite really kind of come out what that new business model is going to be. I mean, because I think when I first started, when you charged a commission, it was $35, $40, $45 around turn. Now it's like $3, $4, and if you're an active trader, it's probably $2. And so the rates have all come down, interest rates all come down. So the business model on the FCM side is just in a little bit of a shambles. And also, you got to realize a lot of these guys that are running, these big firms were ex-traders, and so they certainly don't want to fail. My hope is that this is the end of it, and I think the NFA. I mean, there is no FDIC insurance. There is no such thing on the future side, So maybe some of this may start to happen. That the futures business needs to do some of these things to protect farmers and some of these account holders. My hope is this is it. I'm not sure.
I think that's a great point, especially for some of the small guys, for sure. Let me ask you though, if you've been in the space, you've been in this industry for a long time, if there can be a Madoff in existence for 20 plus years, if there can be a Wasendorf in existence for 20 plus years at PFG, both of these guys are complete frauds. They're making stuff up. They're just ripping people off. If there can be two of them out there, we now know it's not a lone wolf. It's not just Madoff. Can you agree with me that there's a third one out there and we just don't know who they are yet, and it's probably a fourth?
I hope not. I mean, I certainly.
But hold on, in your gut of guts, there's a third one out there. We just don't know who they are. Is that a fair statement?
It's a fair statement.
Yeah, that sucks. That
sucks. It scares me, and it makes me not sleep well at night.
Yeah.
And obviously, I have to protect my clients and protect friends that have been in the business. And I've had tons and tons of calls over the last week or so saying, "Where should we go? What FCM is the best?" And and I have some opinions, on that. But
is somebody in the regulation space going to at least check cash balances at the banks now? We're going to at least get to that basic level?
Well, I think all you really have to do is you got to have at least the regulators be able to go to the banks themselves and say, get the statements themselves, rather than, they still call me if NFL regulator says, okay, Brad, I just need to see that balance. Can you fax it over to me? They need to be able to do it themselves. I mean, I can obviously doctor it. Anybody could really doctor it. If you really want to commit fraud, I mean, the same thing you have on, Goldman Sachs or, Lehman or Bear Stearns or all these things. If a person really wants to defraud you out of money, it's very difficult to stop them.
Yeah, and I've been thinking about that too. That is a tough aspect of life. I think a lot of people want to look to DC and think a bunch of nameless bureaucrats that don't dress very well, who sweat a lot in DC during the summers, are somehow or another going to fix everyone's lives. And if there is some scumbag out there that wants to rip you off, like Wasendorf at PFG, he's going to do it. And so the question becomes, how do we as human beings size up who we're involved with? And, I used to always wonder with Wasendorf, because I remember years ago, I was like, well, hey, where'd this really shiny SFO magazine come from? Boy, this just appeared on the scenes, and it makes futures look like a terrible little whatever. And then, see, now you look back in hindsight, and you're like, well, clearly he was, it was fake.
Yeah.
It's sad. It was fake.
No, it is sad. No, and I think, to a certain extent, that's the futures business is built. Think of how the futures business started. I would say I sold you one, and you'd say I'd bought one. And that was it.
Trust.
There was no contract. There was nothing else.
It's trust.
So the business was built upon just me and you trusting each other, and we weren't going to have an out trade the next day. So that's one reason I'm a big believer in the futures, the guys in the futures space and the people I know and, I trust. It still has to be involved in that because it is all a trust business.
Yeah.
And I think 99.5% of the people are great people, but obviously, we'll find out.
The outliers can make everybody look bad.
Yeah, that's for sure.
Let me tell you. Let me circle it back, and I can't keep you all morning here, but let me get you to talk some about your, because you've written thousands of systems over the years in your career. You've written testing platforms, and I think, for lack of a better term, you've probably written your own versions of TradeStation. Fair assessment?
Sure.
So how did you, and I want you to talk about that, how you got that background, maybe how you learned, and then we'll kind of move into talking about your fund of funds today.
To tell you the truth, my program is just pure grit, just doing it. Learning how to do it, and there's a certain light bulb that goes off when you learn how to program. And most programmers you'll learn out there, they didn't go to school, for computer science. They just did it because they loved it.
Yeah.
And that's to a certain extent how I did it. 15 hours a day, just gritting it out, learning from different people, going on to blog sites and learning how to do it. And obviously you had a TradeStation in the early years. I used some of that, and then I kind of built my own TradeStation. I just did it, through just because that's what I wanted to do, and I needed that tool to be able to create the systems I wanted to do. And so that's kind of how I started. It's just you just have to have the will.
The will and the need. I guess it started with the need first. You needed something, so then you had to apply the will to make it happen.
Yeah, my first one was with Liz Cheval, and she needed a testing engine, and I worked in the middle of the night, and so that's what I did. I traded, and then I built a testing engine for her. Those in the early to mid '90s is what I did, and that was my first job at Rotella. They had 6 or 7 different testing engine. Robert had one, and we had 4 or 5 other researchers around the world that had one. My job was to create one, because the problem with having multiple testing engines is you can't verify what the results are. So somebody sends you a system and it's, oh my gosh, this is the best system I've ever seen. But then you find out there's an error in the coding. If the open is less than the close, they buy on the open, sell on the close kind of thing. Obviously historically you could do that. And so that was I guess it all came out of need. And Robert Rotella, I built his, and I think they're still using a good chunk of, what I wrote for him. And so the testing is an extremely important aspect to the CTA business. Without it, you reliant on a TradeStation. And not that that's not a good tool, but especially now that everything's moved to multi-system. If you're going to trade $1 billion, you don't need 1,000 systems. You probably need 12 to 15 systems. You can pretty much take care of most of your risk with that number. But you need a good foundation and a good way to how do you combine those systems? How do you trade different instruments within that system? What's the correlation on your systems? There's all kinds of higher level math that you need to be able to incorporate into that testing platform that you can't get in a TradeStation or any of the other things that are out there. So most people do write their own.
Yeah. Now, I think the caveat could be there. You were talking about if you're managing over $1 billion. So there's plenty of people that'll be listening. They're probably individual traders and trying to take lessons. from what you're saying. And I guess TradeStation's not a bad place for the individual guy.
It's definitely not a bad place. And especially if you're trading a couple instruments and you have a good idea of how markets work, TradeStation's phenomenal. You wouldn't want to put in, the work, to do it, even though I think it's a good thing. It teaches you a lot, teaches you how to do indicators and, the math around it. And, it is a good thing. And then also you start to realize, okay, if I trade crude oil and I trade, S&P 500, how do those two interact?
Yeah. And I'm sure
it's becoming more important.
Even if you are not involved in every last bit of the programming, the foundation that you've established for yourself allows you to work with a young person today, maybe presents something to you. And by going through this whole process yourself, you can just look at what they've done and be like, you kind of immediately know whether they've put the time in or not put the time in, or whether they've flubbed something here or there. And it's just nice to have that kind of, I know what's going on here. You can't push it past me.
Well, I think that's kind of been the foundation of my business for the last 7 years is I've gone to all the way down to, simple programming, to managing groups of programmers, to, marketing funds, to organizing funds, to, I've gone the full gamut, I guess, in the business. And that's where I've kind of built my business over the last, 5 to 7 years is helping people out. I did a full turnaround of a CTA in Europe, and we had a trading operation in the Bahamas. And, that was the same what I kind of saw there. They had a couple, good systems, but if they wanted to manage more money, they needed to broaden out what they were doing. And I spent a couple of years helping them, broaden out their systems and then going out there and marketing, their program and their company. And so I've kind of gone from, I guess the whole area of the CTA business, and that's kind of what I've been doing.
You're the hired gun.
Hired gun, and I've worked with, some of the turtles over the years and helped them with some different things. I've helped some FCMs and I like that part of it. I guess it's my way of giving back to the business, a business that I really cherish. And definitely some of the best times of my life are being involved in this business and meeting such, just great people. And so I guess I've tried to give back to, some of the new and upcoming people in the business to try to help them learn from my experience.
I have one last question for you. It's kind of, and you could either punt or take it or receive it. So, you've been in this space for a while and you've seen how things happen. And, a government manipulated market is still a market. And especially when you're talking the style of trading that we're talking, systematic trend trading, when you're looking at that price data and you're designing your testing engine and you're designing your systems, it doesn't really tell you what Bernanke was saying that day or what was happening. But are we at a point in time where it feels like, from your perspective, is it different today? Does it feel like that we are in a situation where there's more hands and more levers of power being turned? And I think back to the classic statement, which I'm going to make a little podcast about this and probably poke a little fun out of it even years later. Years ago, when President Bush said that he had to suspend the free market system to save the free market system. Is there any aspect of you and your colleagues in conversations where we just kind of feel like that something is not right today? Because this is what I feel.
Well, I think there's no question. We've had a couple huge turning points in the market. You can kind of prove it, mathematically. I think 94 to 96 was a big turning point. And then pretty much 2009, 2010, was a huge turning point. I guess the key thing, I do believe, I think we're going to have, it is going to be less return, for almost every strategy. Obviously with lower interest rate, that kind of creates some of that. But I think we are going to have less returns for the next, 3 to 5 years. But I guess back to the system side of it, my belief is it's not all about, the entry and exit. It's really about the money management part. And I think as long as you have good money management with what you're doing as a trader, I still think you can make money year in, year out for the most part. If you do it, properly. You let your winners go, you cut your losses. It might be a bit more gut wrenching, now than it was before. But I still think it's certainly possible to make money in these markets, even though I agree it's definitely changed. And I don't think it's going to change back for some time.
Yeah. Brad, I'm sure this has been a really interesting conversation. So I'm sure people are going to want to reach out to you, and maybe they'll just bug the hell out of you. You're going to be like, Mike, why did I do that damn podcast with you? But what's the best way for people to reach you if they want to kind of find out more about you, perhaps make contact? How can they find you, Brad?
They can definitely do LinkedIn. I use a lot on LinkedIn. If you get me there, and then even on my LinkedIn account, you can pretty much see my email and cell phone. I'm certainly more than willing to talk to anybody. Okay. You're in this business and you love this business. I certainly would love to help anybody that's out there.
And just so you guys know, Brad's last name is spelled Rathe.
Yeah, it's just Brad Rathe, and you go on LinkedIn, you'll see me there.
Okay. Hey, Brad, listen, I appreciate it. And, I didn't mention it earlier, but I'm connected with Dave Cheval on Facebook, and I'm going to have to get him to get on the podcast, too, because I'm sure he has
you really?
Yeah.
Dave's an unbelievably good guy. I've not talked to Dave in years, and just still one of the greatest guys in the business. So, no, I highly recommend it. Okay. I recommend it. He's a great guy. Good stories. Oh, my God, good stories.
Listen, where are you today? Where are you calling from?
Actually, I'm in Madison, Connecticut right now.
There you go. Okay.
Yeah. And I still go back to Chicago probably at least a week a month, but I'm on the beach right now. So
there you go. Head back to the beach, man. We'll talk soon.
Okay. All right. Thanks.
Take care. Bye-bye.
All right.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.